Hey everyone, me Kevin here. In this video, we've got to talk about the consumer capitulation updates and what the heck happened today with the data. What is it scary for? Let's get right into that. We do have two messages though. Number one, the comments down below will be off because they're cancerous, they're toxic, and I can't handle it anymore. So it's either I'm not making videos or I have no comments, at least for the time being. I hope to bring it back in the future. I'm sorry about it. I can't take it anymore. Next, I'm only going to do one pitch, and it's going to be right now. The coupon code expires on the 28th. You all know that for the programs I'm building your wealth link down below. That's it. No other pitch this video. Okay, let's move on. So first, one of the big things that we've really been talking about has been retail capitulation. And it's time for an update on this because we're going to get an update on the consumer as well. Retail capitulation is really, really interesting how it works because it comes in these massive spikes and it's usually representative of the bottom of the market. What you're going to see is a indicator. I'm going to put up a chart up. And what I want you to look for is when there's this bright purple line that goes way to the top, that's a sign of per day retail capitulation, which is measured by out of the entire market, what percentage of stocks did retail sell versus institutions. And when the per day line goes way up, especially above the 60% line, that's a sign of capitulation. When the 10-day moving average goes above 60%, it's also a sign of retail capitulation and a potential bottom of the market. Now, why do we know that's true? And why am I pre-explaining the graph? Because it's very complicated when you first see it, but now that you have this, you'll understand it. But why is this so important? Because the dates of retail capitulation, watch this, folks, December of 2018, the bottom of the freaking market when the Fed freaking U-turned. March of 2020, baby. And another time retail capitulated was actually a time I said, this is absolutely ridiculous. We should all be using this as a phenomenal buy the dip opportunity, which was absolutely true, was the November elections, the November 2020 elections. That's quite remarkable that we actually had, seeing in this chart, retail capitulation levels at those levels. And so looking back, we're like, okay, yeah, those are great points. When was the recent highest point that we've had in retail capitulation? So those were all around over 60%. We'll look at the chart in a moment. But the recent high was about the end of January, which is also when I happened to say, that's it, we got to sit this market out for a while, which is kind of interesting to see. But what's also very, very interesting to see is where we are trending now from that capitulation point. So let's pull this chart up here. Look what we got here. This is the chart. Again, I told you it was going to be a little complicated. I'm going to walk you through this one. So the first thing I want you to see is right here. See these green circles right here? These are capitulation points of over 60%, which is that red dotted line there, right? Here you go. You've got a couple of peaks. You have the highest 10-day moving average right here in recent capitulation. And then right here at the end of January, you get a spike. And we do have another spike over here in March that's relatively similar. But what I want you to pay attention to now is that moving average, which is the blue line, and look at what we've really done. First of all, we've consolidated into this lower section over here, right? We could see that coming out of the last 2 years of FUD and uncertainty and madness, look at the trend here. The trend has actually been that retail is not selling. Like when you draw these trend lines, it's like, damn, retail's getting it. Like, this is the time of our lives. And okay, now that sounds like it's like some kind of motivational video coming up. You know, somebody needs to start playing some music like The X or whatever. But anyway, this is the time for us to build our portfolios. And it is a gift that we have paying in the markets. And I think retail is getting it. And it also shows that right now, even if we just look in over here, it's really institutional selling. In fact, when you see the market open and you see the market do this, it goes over and then all of a sudden it does that, it's because the algos are out selling. This is they're selling and playing bets and placing bets because of the Fed. Because we're worried that, oh, the Fed's going to have to move from basically fighting inflation to the markets like crap while the Fed's fighting inflation. We're going to see them push us into a recession. That's going to be a problem because if we go into a recession, what does that mean for us, folks? Well, it means problems because take a look at this. You remember this. Maybe you've seen this chart before. Maybe you haven't. The first time I brought this up was probably about 40 days ago. So the green arrows where I first brought this up, which probably means we are closer right now to over here, somewhere right kind of there where the red line is, which I'm just going to get rid of for a moment here. You know what? We'll make it this sort of red section there that I've left. And the problem with this section is it tells us that if we take all bear markets going back to 1929, that if we end up being in a recession, we have two more bottoms ahead. Those two bottoms right here on the right are what we still have to look forward to. And those are percentage declines in the S&P, which would suggest that the S&P could go down to anywhere between 24 to 29%, which we haven't seen yet year to date, right? In fact, well, let's just look really quick for giggles, because it you know, every day it changes, right? So you just type in SPY stock, and we're only down 17.91% year to date on the S&P 500. So it really suggests that if this is 24, this is 29, we still have potential pain to go if we're heading into a recession. And now we've got this fear that the Fed's pushing us into an artificial recession, or like a technical recession, when the consumer is still strong, and we've never really had a recession where the unemployment rate was going up. Usually when you're in a recession, like in a recession, a declared recession, the unemployment rate's going up. Like, that's not happening right now. The unemployment rate's down. We're still seeing job gains. It's crazy. So this chart is definitely one to be concerned about if we don't have a recession, the gray line, which on Thursday, on the 28th, very special day, July 28th, we are going to see whether we're in a recession or not. And I think it's really going to be a dictator as to, are we going to follow that gray line, or are we going to follow the black line? Obviously, fingers crossed, I hope it's the gray line. I am mostly in the market. I've made many videos on this, both publicly and with course members, but I think I've been very clear. I'm mostly in the market here. I was a buyer today. I'm 80 to 85% in. I have no margin at all, which I'm very glad about. I've converted some of my real estate to stocks as well, and I paid all my taxes. So I'm really in a position where I'm ready for this market to rip, you know, but I'm willing to be patient. Okay, good. So what's the data that came in this morning that's a little bit concerning? Well, the data that came in this morning was another consumer confidence miss, which it's so weird because it's kind of like, I almost feel like the way they measure consumer confidence is they go up to people who are sitting at restaurants or who are partying and traveling going, "Hey man, how you doing?" "I'm great, dog." And then they're like, "Well, how do you feel about the economy and spending?" "Shit, man." It's like, all right, we're putting you down as a negative. Like, that's just kind of what it feels like people are doing right now. Like, people are having a good time. People are mostly happy, which is a great thing. So consumer confidence numbers, though, this morning came in at 95.7 versus the expectations of 97. So yet another miss here. But beyond that, annualized, and I hate that they're doing this, but because annualized means multiplied by 12, right? Annualized home sales plummeted versus expectations. We were expecting 655,000 new home sales, new construction home sales for the year, an annualized sort of rate. We actually came in at an annualized rate of 590. That's an over 10% miss. And get this, folks, we saw prices go from $444K to a median price of $402,000. That means the real estate crisis is starting. I'm telling you, folks, you know I'm a big fan of getting ready to buy real estate. And that's what I'm doing. I'm looking to plop as much money into stocks as I can right now and have no debts. So that way, when the stock market rips, whether that's what I think, the second half of this year, closer to the end of the year, the better, and then it's real estate buy time, I'm actually using stock money that I've gained to go buy more real estate. Now, if I'm wrong and the stock market crashes more, then I guess I'm buying less real estate. Okay? But that's called placing a bet. So we've got a few other charts to talk about, and then we're done. All right, so this is important. S&P's decline, driven by price to earnings so far. Hold on, actually. First, I have to show off. Does anybody, I would say comment down below, but you'll have to hit me up on Discord by going to metkevin.com/chat. Does anybody actually use like these little things for espresso? They're so convenient, and clearly I need to have some more. Delicious. Actually, no, espresso is disgusting, and I don't put any sugar in it. I don't know why I punish myself. But then after that, I have the little Orangina things, the little gummies. They're so freaking good. I don't have the bag near me, but anyway. Okay, so S&P's decline driven by a price to earnings so far. So this is an interesting chart. So you see the blue line here is a percent return due to margin expansion, and the black box is a percent return due to earnings growth in 2022 year to date for stocks in total. and because we've seen compression in earnings, basically, because multiples have kind of contracted, or at least the multiples we're assigning to earnings, which are compressed by margins. Simply put, the point of this chart is just to say that most of the S&P 500 decline has been the result of, right here, multiple compression and margins getting squeezed by inflation and multiple compression. Whereas we've actually had positive S&P growth because of earnings growth. And so when you combine these two things, you get that total net, like what, negative 18-ish% year to date for the S&P 500. But this chart, according to Bloomberg, is suggesting that they believe that most of the negativity that we've seen so far has been margin and multiple compression. And that's a problem, because if this black box ends up becoming negative, then that black box has to add to the blue box like a Lego, and then you end up going to, negative 24, negative 30% year to date while we're in a recession, and boom, you've got your explanation as to why you're down another 10% on the S&P 500. Meanwhile, of course, retail buyers don't give an F. Now, this is a neat one. This just shows you of the S&P 500, which is the blue squiggly line, and then retail buying, net retail buying into leveraged ETFs. And it really shows you that even though there are a lot of people, usually in the comments, writing stuff like, oh, I'm making so much money off of my triple QQQ, and then other people, that's usually on green days you get that. And on red days, people are like, oh, I'm making so much money off my SQQQ. It's like the comments always come out to prove themselves right, but whatever. I think it's really, really interesting that retail had the lowest inflows right here around June 22nd, a little bit about the third week of May, and roughly around the second and a half to third week of July. I don't know what it is with that time in the month, like right around the 20th of every month, that sees the lowest inflows into these funds. But the one that really corresponded with the S&P bottom was over here in June, which is around where gas prices peaked. But beyond that, I can't really tell a difference between buyers going in, via this over here and this over here. I mean, this is probably a little bit more consistent and thick over in March, so it's become a little maybe sparser, but I mean, there's some interesting points where people go shopping. Who knows? We can talk about it in a Discord. Remember, metkevin.com/chat. That's totally free. It's not a pitch or anything. Retail positioning, here you go. You've got, this is Z-score. Okay, I don't really want to explain that right now. So instead, what we're going to do is and go into a park. Have a wonderful day. Thank you so much for being here, and we'll see you in the next one. Thanks. Bye.